Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Peter Hodson, Chief Investment Officer and President of I2I Capital Management, will be joining us for the hour. Then in 30 minutes, Kelly Higginson, President of Restaurants Canada, it's going to be a busy day here for many bars and restaurants, of course, across Canada at St. Patrick's Day, and she'll be here to give us an industry outlook on just how it's doing overall. And we want to hear from you this morning on First Call. You can reach us with your questions, and we'll have Peter answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. NVIDIA CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion US in sales through 2027. Huang was speaking at NVIDIA's biggest annual event, where he also unveiled a variety of new products. Huang announced plans to push deeper into central processing units. He also introduced new semiconductors and NVIDIA's plan to develop chips for data centers in outer space. Canadian home prices dropped in February, continuing a string of declines. The Canadian Real Estate Association says the benchmark price of a home fell 0.6% from last month. Canadians seem to be cautious because of economic uncertainty caused by the trade war with the U.S., the war in Iran as well. And continuing to have an effect, that war, oil prices rebounding after the first drop in almost a week. This comes as Iran continues to attack energy infrastructure across the Middle East. The strikes further hampered the outlook for global energy supplies as the war enters its third week. A near complete halt of shipping through the Strait of Hormuz is starting to impact consumers, especially in Asia. Oil has risen more than 40% since the war started on February 28th. And that's a continuation of our top line story. It's day 18 of the Iran war. For more on the volatility and impact, we turn to our guest for the hour, Peter Hodson, Chief Investment Officer, President at I2I Capital Management, and a psychic and a seer to try and, Peter, thanks very much for joining us today.
Thank you.
To try and figure out what is next, where it's next, and why it's next.
Yeah, absolutely. I mean, you have to go from a fundamental analysis point of view as a stock investor to what is Trump going to put on Truth Social later tonight. It's really, it's really a scary game right now, because I don't know if they've got a plan for an exit. And of course, Iran cannot defeat the U.S., so their only strategy is to wreak havoc in the world economy through higher oil prices.
Which in some way they're kind of winning then.
In terms of their strategy, they're doing it, excellent. We got a 40% increase. No one knows what's going to happen with the Strait. You've got everyone's cutting back in production, and of course, it's being felt at the pumps, which is where America is going to see the difference. And that's probably the biggest problem for Trump as you go into November. If gas prices are twice as much as they are right now, he's going to have a hard time kind of winning those midterms. And so, but the problem is he doesn't have an exit that can be declared a victory. Like if they just withdraw and they say, okay, we won, I'm not so sure they have. The other problem, of course, is economic. I mean, almost every single product has an oil influence on it. Mm-hmm. And the 4 or 5 past kind of really bad recessions were triggered by an oil price shock. And you do not want to get into a 1970s scenario where there's a stagflation scenario where oil prices just stay elevated and there's very little growth. I mean, that's almost a worst case scenario for investors.
Well, we've just seen oil hit, or diesel in the U.S. is now $5 a gallon.
Yeah.
What would that translate to? 3.8 liter, I don't know, about $1.80 a liter?
Yeah, don't make me do math on TV.
Nobody get mad. That was very, very, very quick math on what that is. But $5 a gallon.
It's a trigger point.
US,
I mean, it's a psychological point as well. And but again, there's not a strategy to get that back down again. And you have to open up the Strait, and you have to get production back online. The only thing that could possibly help is honestly a slowdown in the economy, and that might temper the inflation impact of energy. But that's not really what you want either.
We really are in tail of the dog right now.
Absolutely.
I mean, because for Iran, this can go on to a degree. Their ships are getting out.
Yeah.
Their oil is going to India. It's going to China. Their money is coming in. Their ships are getting out. And it costs them nothing to lob the occasional rocket or missile, relatively nothing compared to what the Americans are spending
Absolutely.
to try and win this war compared to what Iran is.
$10,000 drone versus a $3 million missile is a big economic shift. And of course, on the other side, Russia's benefiting from this as well. So poor Ukraine, they're doing such a good job protecting their country, but now Russia's allowed to sell. They're making huge profits from the increased price, and they're allowed to sell again. So it's a pretty bad scenario worldwide.
Now, and I mean, a big one with this, the concern, I guess, China, what kind of an impact if they face oil pressures? I know they have a stockpile. They've been building that for the last little while. But, I mean, what kind of a pressure would they face? And then what would that carry over to here in any way?
Yeah, they certainly will see some impact. But I think the key difference is they're a much stronger economy overall. They don't have the debt problem that the U.S. has. They're not fighting multiple fronts like the U.S. is right now. And they've got sort of a strategic long-term plan. So absolutely, it will hurt, but it's not going to destroy them, and it's not going to. Of course, their citizens have less ability to fight back high prices anyway. But certainly, we'll see a trickle-down effect from that as well if they stop buying U.S. products because there's an economic shift there. Again, it just kind of stacks upon stacks on different problems and various levels of problems that you have to deal with. So it's hard to be real positive, except from a contrarian point of view. I mean, Trump could change his mind and say, okay, that's it, we're out of there. And then oil goes back to $70 and everybody's happy again. It's not beyond possibility. It's not likely, but it could certainly happen.
He could argue that they have seen success. They could say they've taken out the nuclear program. They took out the head. They've forced regime change to a degree. I mean, did they get the revolution that Trump called for? No.
But they could go back to status quo.
Yeah, absolutely. They could argue that, and they are ahead to a degree because then the nuclear threat. But then you've got Israel going, well, we're done yet.
Yeah, exactly, and that's where it gets. I mean, it's really a multifaceted situation, and I don't think the U.S. sort of understands what they're doing there. And there was nothing other than the nuclear program. Status quo was working very well for every other country, basically. And I do agree that you don't want Iran having nuclear capabilities. But to set off a whole situation in the Middle East that may just make it worse. It was already bad, but just to exasperate the situation, I don't think is going to work out well for the U.S.
Well, and the end result we could see, because I was watching, saw a number, I think the European markets have pulled back, and they were outperforming the U.S., are now not. You could lose the Middle East. All that large asset was developing. I mean, Saudi Arabia was ready to work with Israel, things like that. We could see all that loot fracture, and they could lose all that, and America could find itself incredibly isolated.
Absolutely. They've basically thrown the rule book off the table, and now they're going to have to set new rules, new partnerships, and a new regime and a new strategy. And I don't think they have that yet. I mean, they might, but it's certainly not being exemplified by what they're doing.
All right, 3 more years of this presidency, but it may change. I mean, of course, the midterms are the huge thing, and that if he is willing to listen to his handlers, they've got to be looking at the numbers right now.
I think
going back to them, and that's everything for you.
I think that's the best thing we've got is they have to do something to win the midterms, and having a big war in Iran is not the right thing to do.
And so if the prices come down, maybe they can hold on. But if the Republicans lose, he's hamstrung for the back half, and they will hamstring for the entire thing. All right, lots more to talk about on this when we come back. But next up, we'll take a look at the markets before the bell. Let's take a look at the market, see how they are shaping up. We'll start with U.S. futures, and it's look at that mixed bag, cautious day. Everybody trying to figure out what is next. You can see the Dow up slightly, 0.13. Nasdaq pretty much a wash on the way down a little bit, but and the S&P 500 up ever so slightly again, pretty much a wash. Heading over to Asia, and similar situation. Everybody not sure what to do with what, and the Nikkei down slightly. Hang Seng up a little, and then the CSI 300 down by 3/4 of a point. Heading over to Europe, and the cyclicals and financials were soft, but look, now that they've turned around, and they're all rallying. When I last looked, they were down. So FTSE's up 0.68, almost 0.7%. Bit of a rally going on there. CAC 0.54, and the DAX by 1.16. TSX yesterday finished in the green for St. Patrick's Day. We'll see what happens today, the actual day. Up more than a percentage point, led by tech and consumer staples, but all sectors were green yesterday. Some of the winners and losers now. Oh, well, I'll tell you, we had a couple of them that were winners. Altus and Lundin doing well. Go Easy and Nutrien taking hits yesterday. Heading over to the metals. Let's see what gold, silver, and copper are doing. I don't think anybody knows what they're doing today. It just seems like going in different directions. Gold's up slightly, hanging in above 5,000. And silver off by 0.4%, down around 80. And copper's dropped down by about 1.2% to 576. Western Canadian Select now. Taking a quick look at that yesterday. It dropped more than 6%. Yesterday was the good day or yesterday was the bad day. Good day depending on who you're talking to. If you own oil, it's a good day. If you have to get gas, it's a bad day. And today, where are we at? There you go. It's on the way up again. WTI is up about 2.2% at 95 a barrel. Well, Canadian home prices dropped in February as lingering economic uncertainty forced sellers to offer bigger discounts to reluctant buyers. The benchmark price of a home in the country fell 0.6% from the month before to a little more than $660,000, $661,000, continuing a string of declines. For more on what the Canadian real estate market can tell us about the economy in general, let's bring in Peter Hodson, Chief Investment Officer and President at I2I Capital Management. Yet another down month. Is this a sign of the economy, or is this just housing kind of being more realistic, do you feel?
I think it's both. If you look at the fourth quarter GDP in Canada, we were down 0.6%. So certainly not a booming economy right now. Then you've got a situation where there's still some 5-year mortgages renewing from very, very low rates, and people are seeing $1,000 increases in their monthly payments, even more. And then you've got sort of just uncertainty in general. You had the job numbers last week, which were not great. Throw that on with the war situation, and people tend to be a little bit more cautious. And the situation for getting into a massive bidding war and bidding up prices, I mean, that's completely gone now.
That's gone.
Yeah, and then, of course, simple supply and demand, the actual number of houses that are up for sale is higher than it was. I think it's 0.6 or something like that. So you've got supply demand, you've got the psychological factors, and you've got the real life factors about jobs and inflation.
And also immigration, too.
Absolutely.
And immigration.
You've got the immigration changes, and you've just got less. You have less population. Canada's population is expected to decline over the next 3 years. And so, if you look at it, it's like, how does a house price go up in this environment? So until we kind of get through and get back into positive GDP growth, or until we get job growth, or until we get lower rates, it's probably just going to stagnate and perhaps drift a little bit lower. So
at this point, I'd like to bring in the Bank of Canada and the governor. And what does he do with this? It's a hodgepodge, right?
Yeah.
Where does he go?
It's a tough call because they obviously are aware of the inflationary impacts of energy. And they're looking at it and going, okay, what happens if oil prices go to $140? What's inflation going to do?
Or 200.
Yes, and how do we fight that? So, but then again, you're at a negative GDP, and you've got declining jobs, and you've got a situation where you might want to get ahead of a recession and try and stimulate the economy. So I wouldn't want to be in their shoes. I think they will hold.
Yeah.
But I think the right move is probably to cut. And
really?
Yeah.
Because they had talked about a possible hike towards the end of the
year.
year.
I think they're going to wait to see the numbers. But I think the issue is the psychological impact of what's happening in Iran, I think, is far more important than actual price inflation. So, and so in other words, you might not see inflation for a year, but people are going to back off because they don't know what's going to happen. They don't know about the job numbers. And then if you throw in the AI fear, it's like, is my job secure because the robots are coming? It's not
and it's not even robots that are coming. It's just a machine.
Absolutely. And it's not a situation where companies are going to say, hey, let's go out and spend $500 million and expand. That's just not the situation we're in. So I think an indication that the bank is saying, you know what, we're on it and we're willing to do something about it. And if inflation kicks up, they can always change their mind. But right now, the real numbers are bad and the economy is bad. Inflation might be the next problem, but you have this problem right now.
And with that, and if they do drop it, say a quarter point, would it be mostly for the psychological? Everybody feels a little better because the rates are down. Would it make a big difference?
Nothing huge, because you still have that
So they could
psychological
afford
problem.
to do it.
Exactly, and obviously it benefits companies. They're looking to borrow, and it would have a small impact on mortgage rates. But it's really more a statement from the bank saying, we know what's going on, as opposed to just saying we're not going to do anything and we're going to watch it. But by the time a recession hits, it's typically too late. It's already happened.
And I mean, it's really, I'm trying to think of when we have a trade war going on with the U.S., our most vital trading partner, and the negotiations are coming up. Maybe they are, maybe they aren't. We've got a potential war that could explode. Oil prices soaring. Housing market, the economy is still. Have you ever, I'm trying to think if we've had this perfect storm.
It's the layering upon layering of different problems is a bit new. I mean, obviously, I've never been in 40 years in the business. I've never seen a situation where it's all good. There's always something to worry about. But it's sort of one day after another. It's kind of the cockroach theory. It's like you're scared to open the news in the morning to see what's happened. Now, obviously, that does create opportunity when everybody hates everything. And some of the best investments have been made when psychologically.
All right, so what's your opportunity right now?
Well, I think some of the energy is obviously a good play. Everybody hated energy last year, and now it's like everybody's favorite. But the key point is even with the big move that the energy sector has had, these stocks are really quite cheap versus almost every other historical cycle. The other issue is they're in far better financial shape. Everybody hated this sector. So they paid down debt, they bought back stock, and they increased dividends. And versus other cycles, they're like absolutely pristine in terms of financial risk. And so, yes, it's a cyclical commodity and it's a cyclical sector. But unlike other cycles, if the sector turns, you're not going to see bankruptcies in the sector. It's just very, very clean.
It's going to go for a while.
Yeah. The other sector, I mean, defense stocks, obviously, the situation is not going to result in countries cutting back on defense spending. It's kind of the easy, obvious one. And those stocks have run also, but again, what happens over the next 10 years? There'll be more and more spending as countries realize that the game may have changed and they have to protect their own situation and not rely on partnerships. Then, of course, if you want to be defensive, you can go into the typical people got to eat. You go into names like Loblaws and Metro and things like that. I mean, that's a nice place to hide. They are a little bit vulnerable to higher rates, but not nearly as much as other companies. And then technology is not going away. Absolutely, it's volatile. But if you want a company that's growing at 40%, that has cash, that's got super high margins, that's the sector you have to go to.
All right, we'll wrap it up there. We've got lots more to talk about. And up next, Peter will be discussing things that are on his radar, including AppLovin. Time to see what's on the radar for Peter Hodson, Chief Investment Officer and President of I2I Capital Management. And there are a few stocks showing up for you. We'll start, though, with one some people are loving, some people are hating. AppLovin?
Yeah. So we were talking about companies with high growth, high margin. So AppLovin has a 61% net margin on everything it sells. Their growth rate is in the 65 to 70% range. It's a $100+ billion market cap company. It's down this year, but I think it's tripled in the past couple of years. So AppLovin is a digital advertising company that allows advertisers to pick their spots. So for example, if there's a TV show that's got a Hallmark movie and it's very sad and everybody's depressed, they'll put in an advertisement for tissues. I mean, that's the simplest example, but that's exactly how it works. But it's all self-run by the advertisers. So the company does not have a lot of employees. They're actually very, very lean. They make a ton of cash flow and they're doing very well. But the thing is, half of Wall Street thinks it's the greatest company they've ever seen. Massive margins, massive cash flow, not hiring people, and massive growth. It's a great combination. The other half of Wall Street thinks it's a giant scam. And there's been 6 or 7 very vicious short attacks on the company saying it's a money laundering company. They're cheating in terms of using Google and Meta's input. And so the stock is just exceptionally volatile. And here's a very simplistic viewpoint. If it were a scam, you would not give it such a stupid name. but
you never know. Maybe that's the brilliance.
Maybe
the brilliance
it's
of it, right?
brilliant. But the growth is there. The valuation is is much more reasonable now, but it's really just net margins. And people are saying, how do you do it? And how do you do it? So they took a big hit this year. It's down about 36% on the software scare, and AI is going to kill everything. But they actually utilize AI to help their advertisers. And they've done a very, very good job. Now, whenever you get a company with high margin, high growth, you do get competition. So there is competition, and this is perhaps the short sellers are trying to sort of attack it in terms of what the problem is.
Okay, but any of these accusations stuck against it?
No, not at all. I mean, the company, if they were cheating on Google and Meta, Google would know about it.
I think so, yeah.
Money laundering for a $100 billion company just makes no sense whatsoever. Yeah. And again, but you've got this stock that's gone from $80 to $500, and so a short report comes out, it goes down to 400 because everybody's made a lot of money on it over the past 3 years. So it is a very polarizing company. And every day you don't know whether it's going to go up $100 or down $100. But the actual fundamental numbers, if you look at it, are very, very impressive in terms of its return on equity, and its efficiency is just quite amazing. So, it's not a stock that everyone should own, absolutely. But it's very interesting, I find, because of that massive fight between the two. Because usually analysts are they say everybody loves it or everybody hates it. And now it's just this massive fight.
Oh, all right. So it's a real stock then.
Yeah.
Some people love, some people hate. Hydrograph Clean Power.
Yes. So first, I want everybody at home to say this is not a recommendation. This is a discussion. So here's a company that is involved with graphene. I'm not a graphene expert, but graphene has multiple uses, electronics, batteries, composites.
And this isn't the same that's in your pencil, like when you're reading it.
No, it's the little hexagons. So it's a situation where this company is being very heavily promoted, and it had a 2.7 billion market cap last week. It's down 36% in the past week. It's very, very volatile. But it's up 2,500% in the past year. And it's just exploded in terms of investors trying to get the FOMO trade because it keeps going up and up and up and up. So I don't want to diss it, but I don't want to endorse it because it only has $20 or $30 million in assets for a $2.5 billion company.
Wow.
So I want people just to be aware of the risk here. There's a lot of expectations that they're going to have huge margins and huge contracts, and there is potential. But it's a stock that went down almost 40% in a week. And if you're a conservative investor, you might not be able to handle that. So I don't know what's going to happen. They're in sort of pilot scale right now. And a lot of times when you go to commercial scale, things aren't quite as good when you ramp up. Again, I don't know what's going to happen, but I just find it very, very interesting that you've got this massive market cap trading on the Canadian Securities Exchange. And everybody loves it, but the financials are not quite there yet.
Okay, well, keep an eye on it. Last one, Micron.
Sure.
And not the hockey skates from the 70s. I love it. Every time I think of Micron, that's what I think of.
The Micron is a DRAM memory producer. It's a $500 billion company now. And what's happening is AI is taking all the memory away from everybody else. And so the price of computers is going up because Micron has actually said they want to focus on the data center market and the AI market. And why not? Because these guys will pay whatever it takes to get memory. So an absolute shortage of supply, and Micron and a couple of other companies, not that many, a handful of companies, have the ability to raise prices almost at will. They're sold out for more than a year. And here's the interesting part about the stock. Excuse me. It's trading at 11 times earnings because in past cycles, it's been very, very volatile. And what happens is the price goes up and production goes up and then demand stops and you get a total collapse. But that's changed a little bit by AI because the discipline of the industry is much higher right now because there's been a lot of consolidation. So there's fewer companies, they're sold out, and their addition of capacity is much lower than other cycles. And at the same time, because they're making so much money, their balance sheet, like the energy companies, is so much better. So in the downturn, whenever it happens, the floor will be much higher than before. But meanwhile, they're just coining it. I mean, their earnings are going from 70 cents a couple of years ago to $20, $30, and $50 forecast. Like it's just, if a hockey stick from the Micron, if you're a hockey player, the hockey stick is just ramping up right now. But it's the valuation. 11 times earnings is ridiculous. Even if the cycle ended tomorrow, it's still kind of a good valuation for the long term.
Okay, we've got to wrap it up there, but we've got lots more to talk about. And coming up, we're talking about slumping drink sales for St. Patrick's Day with our next guest. And Our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Canadian mortgage billionaire Stephen Smith is buying a stake in the Economist Group. Smith and his family's holding company, Smith Financial, will buy the entire 26.9% stake from private investment company Rothschild. The price of the transaction has not been disclosed. The deal is Smith's first foray into media. Kraft Heinz is introducing a series of what it says are healthier products to bolster some of its lagging brands. In March and April, Heinz will unveil high-protein mac and cheese, a snack-sized version of Lunchables, and low-sugar Capri Sun with electrolytes. This is the first phase in the American company's efforts to revitalize growth after pausing its plans to split. NVIDIA CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion in sales, U.S. that is, through 2027. Huang was speaking at NVIDIA's biggest annual event, where he unveiled a variety of new products and announced plans to push deeper into central processing units and chips for data centers in outer space. Taking a look at the markets, and they're on the plus side again today. A lot of people will be happy about that. A lot of green for St. Patrick's Day. Dow up by 0.33, NASDAQ by 0.17, and the S&P 500 up by 0.25. On St. Patrick's Day, some new data from Stats Canada showing alcohol sales have been slowing. So there will be a test for bars and restaurants today as broader shifts toward drinking less start to weigh on alcohol sales. Here to discuss this is Kelly Higginson, president of Restaurants Canada. Kelly, thanks very much for joining us.
Good morning. Thanks for having me.
How noticeable is this shift?
Yeah, it's pretty it's considerable for sure. We've seen this as a decline over the last 4 years, and what I would say with that is that it's happening at the same time as we've seen a dramatic increase in our input costs over the last 5 years. So we've continually see a drop. At this point, we've got 21.1% of total revenues in 2013 were related to alcohol sales, but that number has dropped down to 17.1 in 2023, which is the latest available data. So that's a pretty considerable drop in the last, 3 to 4 years. I think, we're seeing it per person at table service restaurants, a decline from $1,100 per person in 2019 to about $1,000 in 2025 when adjusted for population growth and inflation.
Kelly, you've given us the percentage of alcohol, but in terms of, can you just narrow it down to sort of a per revenue, like a per customer amount? And then also, if you would, what's the next highest margin item on a typical restaurant? Because I know alcohol is the highest margin, but what's the next sort of step and what can they promote?
So this is where we've got the challenges of the spending at table service restaurants. It declined from $1,170 per person in 2019 to $1,050 in 2025. So that is a pretty significant drop. And as to your point, what we've also seen is our, highest cost part is really in food costs and our margins in food costs. So, when we look at the increase in the cost of food over the last number of years, and that's really challenging our operators, the categories in order to find profit has become less and less available to our operators.
And this drop, is it solely by price because of cost? People just don't have the money to spend on that, or is it also they're just not drinking as much? And is it across the board, like from a smaller restaurant up to the high-end restaurants?
So it's a real mix. To your point, we've got 74% of Gen X who are stating that they're reducing alcohol for health and wellness concerns. But 44% of Generation Z are reducing alcohol because they are trying to save money. And the millennials right there in the middle with 51% are reducing alcohol for social and lifestyle cost reasons. So, we've definitely got a mix of all the reasons there. But, the reality is we've got a younger portion of Canadians aged 18 to 22 reported not drinking any alcoholic beverages in the past 7 days, which is a real switch compared to 54% for Canadians overall. So that next generation of consumers are drinking considerably less.
Wow.
Kelly, do you think there's any chance of stabilization here? I always get the situation that maybe one of the parts, and you mentioned it, is cyclical, but in terms of sort of getting down to a level where restaurants can actually sort of say, okay, that's the bottom. Is there any chance of that?
I think we're actually this is all a guess, but to your point, I think we often see the pendulum swing in directions as far as trends, and obviously we do have a chronic affordability issue, which that doesn't seem to be going away. But as far as kind of the lifestyle trends, we tend to see those pendulums swing pretty rapidly, and I do see it maybe starting to come back a little bit. But I also think, as we talk to operators, that we have to meet the consumer where they're at. So let's look at different ways that we might be able to. Is it serving lower alcohol level drinks? So some people are talking about still enjoying cocktails, but they're doing it maybe once a week. They're doing it less often, and they'll spend a little bit more for something that's higher quality but lower alcohol levels. Can we look at more operators? There was a period where we were increasing our ounces and glasses of wine up to 8 and 9 ounces for the large size. Maybe we need to look at having more serving those 3 and 4 ounces, something to sip on while you're having your actual meal. Those are going to be areas that we're going to have to explore. And I think there's definitely a lot of room for operators to explore the non-alcoholic beverage category. There's a lot of different ways we can have exciting cocktails that have no alcohol in them. But there's also some great products coming out on the market, beer, wine, and lower alcohol and no alcohol spirits.
And I think that may be challenging with the price too, because I've gone to restaurants and they have those mocktails. I know they don't call them mocktails anymore, but some of them are almost the same price or not much lower than a drink with alcohol in it. And I think you look and go, well, that's a lot of money to spend just for something that doesn't have alcohol in it. I just want to go back to, I mentioned about, is it across the board when it comes to restaurants, high end, low end? Is there a bit of a K-shape with the restaurants like we're seeing in the economy, where the higher end people are still spending on alcohol and higher end alcohol, whereas when you get down to the lower end, they're holding back?
Yes, where we've seen the biggest drop really is in the category of bars and nightclubs. They've seen the biggest drop over the last number of years. And again, this goes to when you're talking about the higher end. Definitely, we're still seeing the purchases, but we're seeing it. They're spending more on a higher quality of a bottle of wine as opposed to the volume of wine. So this goes to really consumers looking for that experience, and they'll spend a little bit extra to have a really good cocktail as opposed to having maybe 3 mediocre cocktails. And then again, with the wine and other specialty items. All
right, and we're out of time. I just want to ask one more question. It's St. Patrick's Day. What are we expecting for today?
You know what? I'm cautiously optimistic, but I think, if I think back to the days of the lineups starting outside of some of our favorite Irish pubs early in the morning for people to get a seat, I think it's fair to say that those days have come and gone. So, hopefully we see people get out and enjoy their local restaurants, because it's definitely a challenging period for all of us.
Okay, Kelly, thanks very much for joining us today. We appreciate it.
Thank you.
Kelly Higginson is president of Restaurants Canada. Still ahead, Saskatchewan has hopes of transforming into an AI hub. CTV's Alison Bamford has more on that after the break. And our phone lines are open. Peter Hodson, Chief Investment Officer and President of I2I Capital Management, taking your calls. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca. Saskatchewan has hopes of transforming into an AI hub, and there was a major investment announcement today. BCE, the parent company of Bell Canada, and CTV, which is our parent company, is partnering with the province to bring a $1.7 billion data center online. It's the company's largest investment in Saskatchewan. CTV's Alison Bamford has more on the facility's impact on the community.
This open field just outside the city of Regina could house the country's largest AI data center in a year's time,
resulting in a significant contribution to national Canadian data sovereignty.
Bell Canada says it plans to build a 300-megawatt AI data center in the rural municipality of Sherwood, which will increase Canada's domestic AI capacity.
What Bell AI Fabric is, it's Canada's digital backbone in a sense. A full-stack national network designed to deliver AI to thousands of Canadian businesses, governments, and institutions.
Bell says the data center could generate up to $12 billion in economic value. The project could fuel more than 1,600 jobs, 800 during construction, another 80 full-time jobs once it's operational, plus an additional 750 spin-off jobs. Bell says it will focus on Indigenous procurement, an agreement made with George Gordon First Nation.
We want to be involved from the construction all the way through to operations.
Not everyone has been excited about the new build, with online petitions attempting to stop the project before it starts. Many concerned that some AI data centers use large amounts of water for their cooling systems.
The project will use a closed-loop cooling system, meaning it will not draw from municipal water sources.
One main one that I've heard concerns about was the water, and to hear very clearly that there is not a need for municipal water supply is obviously comforting.
Construction crews are slated to break ground here this spring, and the first phase of the facility is set to come online by the first half of 2027. Alison Bamford, CTV News, Regina.
And again, BCE is BNN Bloomberg's parent company. Still ahead, we'll take a look at one of the notable analyst calls and recommendations moving the markets and dive deeper into the auto industry. Let's take a look at one of the notable analyst calls and recommendations moving the markets this morning. Lemonade shares are up in pre-market trading at 7.77 right now after Morgan Stanley upgraded the stock to overweight from equal weight, noting that the insurer is an early-stage winner as autonomous vehicles transform the auto insurance industry. Analyst Bob Jian Wang says, while autonomous vehicle adoption is unlikely to displace auto insurance in the next 10 years, improved safety and driving technology should compress personal auto premium growth to less than 1% per year over the next decade, he adds. Lemonade's Tesla partnership represents an important first step and gives Lemonade first mover advantage in data analysis and on-the-ground experience. Price target set to $85 US from $80 implies a 47% increase from last close. Lemonade has 4 buys, 4 holds, 3 sell ratings among analysts tracked by Bloomberg. Average price target $65.78. Now, for more on the future of the auto industry, let's bring in Peter Hodson, Chief Investment Officer and President of I2I Capital Management. So, I mean, it has a future, and we're still not sure what the future is.
It's just taking...
It was EVs, and it was hybrids now, and then it's autonomous.
The future is taking so long to get here.
I know. I keep waiting and waiting.
Yeah, I mean, certainly the autonomous market has to improve, and we have to get more sort of government official recommendations. I mean, everyone gets concerned if there's a death from an autonomous driver, but obviously it's way less than everybody else is driving.
Well, I mean, there's not many on the road right now, too.
And
I'd love to see the miles driven and see how they stack up.
Yeah, I think the technology is close enough, but you really have to sort of execute it properly. Like one thing that people are throwing out is like make all trucks autonomous. So now everybody knows that the truck is autonomous, and you know exactly what it's going to do, as opposed to, you know, is that Honda autonomous or is that one autonomous? So that, I think, is important. But in terms of future development, I mean, we're still in transition. We have no idea how it's going to turn out. We don't know who the winners are going to be. EV does not look to be the greatest solution in terms of sales. Anyway, the sales are not doing as well as people thought. You've got, massive developments in AI, which I think will push the autonomous thing forward. And companies like Lemonade, they offer a 50% discount to any full autonomous Tesla that they insure. So obviously you might get actual savings. I'm not going to say your insurance rates are going to go down because that'd be crazy. But maybe the insurance company's profits will go up. But again, just like the economy and housing, the car market, is not exactly booming right now. People are sort of cutting back, and their car is going to last a year longer.
They're stretching it as much as they can right now. All right, it's always interesting in the auto industry. When we come back, Peter Hodson, Chief Investment Officer and President at I2I Capital Management, will take your questions on First Call. All right, time for First Call, and that first caller is Bill from Bowmanville. Bill.
Thank you for taking my call. I'd like your guest thoughts on Oracle. Does he see much upside from here? Thank you.
Cheers.
Sure. I think there's pretty good potential. Of course, Oracle was, a massive performer last year, and then it got cut in half on concern about AI growth.
Yeah, it was a fun day. I had some Oracle. It was fun to watch that.
But their earnings a week ago or so, they were pretty solid, driven by AI. And of course, the stock's far more attractive at half the level it was not that long ago. The big issue here is their debt level. They do have an awful lot of debt. And so when this AI party ends, it's not the stock you want to own, because obviously investors will sort of panic on debt when it ends. But I think that's not going to happen for some time. And I think the short-term opportunity for Oracle is pretty attractive right now. Again, this is always assuming a normal market, which is a pretty big assumption these days.
Silly, Billy.
But in terms of fundamentals, I think the price to return potential is looking pretty good at this level. But just be cautious because of that debt, because if it keeps going up, people will discount the valuation as they had over the past year. So.
How much of a factor is Larry Ellison? I mean, because he's up there now. He's 82, I think, 83?
Yeah, something like that. It's a big enough
we talk about a Warren Buffett. Is he similar with Oracle, that when he goes?
The stock will take a hit for sure. But in terms of, his replacement team, and I mean, it's a giant company. They'll be up to manage. And honestly, their products are good enough, and the demand right now is strong enough. So I think they'll be able to absorb that.
All right, we got some emails we want to get in here. Gold's gone down quite a bit. It's gone a bit quiet. I know it's been an interesting run for it. I own several, including ABX, which is looking to split. Do you know if there is a set date for this? And what is your view on gold miners going forward? That's from Craig.
Sure. There's not a set date on the split of ABX. And I think it's like maybe later this year where they'll sort of finalize it. Gold in general, we really like the sector right now because, of course, you've got the political situation. You've got potential lower rates. Sometimes inflation is good for gold, sometimes it's not good for gold. And obviously it had a huge surge, and the recent setback is really almost entirely due to the strength of the US dollar. When there's a crisis in the world, investors go to the US dollar.
Yeah.
Everybody hated it last year,
now.
And now we're at 6 months high in the US dollar. But that's generally a temporary place to hide because no one knows what's going to happen. So gold is impacted by the strength of the US dollar, but as soon as there's a change and the crisis is over, I think gold starts to run again. And it's not going to double like it has over the past couple of years, but the trend is there. You've got central bank buying, you've got investor banking buying, you've got China retail buyers going crazy for gold and silver, so much so that China actually had to reduce margins. And you've got really every currency in the world at risk from overspending. And so it's the store of value. Crypto's not the store of value it was supposed to be. So I think the trends are really good for gold.
Yeah, crypto's been kind of lost in all this over the last
few
weeks.
It's bouncing around for sure. But if you're an investor and you're looking for a place to hide from the crisis in the world, it's not crypto. At least so far, no one's gone to crypto in this problem anyway. All
right. Let's get one more email in. This one's from Ross. Please ask your guest about Thomson Reuters.
Sure. Poor Thomson. It was a fabulous company for triple decades, just generating cash flow and doing so well with a premium multiple. And then the AI eats software scare came along and the stock just got destroyed. But their earnings were pretty good, and the fundamentals were pretty good. And they actually came out with a great AI product on the legal side, which is one of their focus. And they have 1 million customers already, and even Anthropic said it was a pretty good product. So the stock, a little bit similar to Oracle, way cheaper, but the underlying MO of the company and the genetics of the company hasn't changed.
Yeah.
The thing I like about Thomson is they have the financial capacity to make acquisitions if things slow down. They've done fabulous deals in the past, and they've exited properly, and they've bought properly. So if they get really worried, they'll just go out and buy a $10 billion company and say, hey, you know, we're an AI company full in now, or whatever they tend to buy. It's just a really well-managed company in terms of their capital allocation.
And their ability to pivot.
Absolutely, yeah.
All right, we're going to have to wrap it up there, but Peter, thanks as always for
Thank
joining
you.
us. Appreciate it. And that is it for us here on the street. Thanks to Peter Hodson, Chief Investment Officer and President of I2I Capital Management, for joining us today. Lindsay Biscayas with the Open next. Trading gets underway in a little more than 30 minutes from now. Have yourself a great day.